Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome to another episode DIY Wealth Canada podcast. We're here today to talk about cash, more specifically, why would somebody hold cash rather than investing, and then more into cash management. For example, like what do you do just before you retire in retirement? What do you do with cash? Do you have cash sitting, just not doing much, or do you try to earn a little bit more with your cash sitting in your accounts? So yeah, I think it should be an interesting episode. And as we get closer and closer to financial independence, early retirement, my wife and I are certainly looking at this topic quite closely, or mostly me. I'm doing a lot of planning, but explaining to my wife. And I'm sure, Nelson, you're already in early retirement, so that's I'm sure it's an important topic for you. So yeah, that's first off, let's talk about why somebody would want to hold cash instead fully invested, right? So for myself, for the most part, we fully invest our cash. We do keep some cash in our checking and savings account just for day-to-day expenses and such, right? And then we keep a little bit of amount, I guess, more sizable account around. We managed to save up about 25K, 30K last year on a cash savings account. So that's kind of there to use for large expenses. Nelson, what about you?
Well, but my kind of, if you want to call this cash or emergency funds or whatever we call it, just kind of cash on hand. My thinking has evolved over years. When I was younger and I was kind of, go towards, the prospect of early retirement or financial independence, whatever you want to call it, I was very much someone who had zero cash. Like, in fact, I borrowed money when I could and when I thought that it was feasible. And then whenever I had any spare cash, I would either invest it or use it to pay back loans. For me, it was always having cash on hand was a wasted opportunity. And if I did ever have an emergency, whether it was, like something medical, which of course doesn't happen too often when you're young, you get that kind of sense of invulnerability there. But, in terms of car repair, in terms of, a deal, whatever kind of deal that just you have to take advantage of it today, I just borrowed more money. And it worked because, I had assets outside of the ledger, and then I had some liabilities, but the liabilities were never too bad because I was always so quick in paying off the debt. Now that I'm a little bit older and I'm a little bit more risk adverse and I really care more about not screwing up rather than growing the pile at the highest rate possible, I definitely have some cash on hand. I have an emergency fund. I have a very healthy emergency fund. It's close to, I look at everything as yearly spending rather than a certain dollar amount. So my cash cushion at this point is approximately a year's worth of spending. And that's, a little bit high for me because I am putting money aside for a new car. My car is, kind of hurting a little bit. So there's that aspect to it. But the point is that I went from zero cash to now a minimum of 6 months worth of spending of cash. And generally it's a little bit higher than that as kind of my risk tolerance has changed over the years. Bob, let me ask you, in terms of like the cash emergency fund versus cash in your portfolio, do you separate the two, or is it just kind of, this is like the amount of cash you have? Because I definitely separate the two. I look at, I have money taken out of the market that is, kind of my emergency fund. And then I have additional cash on top of that as dividends roll in or whatever. So what's your view on that? Do you view them as like the same? It's just one big cash pile, or is it two separate cash piles? Or do you even do more where you have like, maybe like 10 cash piles and you're saving up for a new car or vacation or whatever?
Yeah, that's a very good question. So for now, we see a separate cash pile. So the money that we put into our investment accounts, like the TFSA, RSP, taxable, if we have cash from like dividends or distribution into those accounts, we don't ever take them out. We reinvestment. So I see that as like cash sitting for investment. And then obviously we have our cash in our savings account, checking account. So those are more call emergency, rainy day fund, or just, money there to use for future. Like we may be planning to, go for vacations that we know we need to spend a few $1,000s there, or if we know we need to, replace an appliance or a car, that it's there to use later. And I think just adding to what you said, Nelson, yeah, when I was early, I would keep very little cash, right? The way I see it is I'm still working full time. There's that regular income coming in every 2 weeks. We have a relatively high savings rate, so there's buffer there. So it's very little point keeping a lot of cash aside. Plus, with credit cards, you don't have to pay off. We pay off in full, but you have like a grace period as well, about a month, right? So there are different levers you could pull to help you in terms of, if you suddenly have a big expense and you need to spend, you don't necessarily need that cash sitting aside. You kind of have a buffer to get that cash and then pay it off. Right. So that's why in my younger days, just like you, Nelson, I didn't keep that much cash aside. Now we've been accumulating cash a little bit more because as we get closer to early retirement, financial independence, the way I see it is the cash is more like a buffer, increases our margin of safety. So that's why I keep a bit. But yeah, to answer your question, the cash that we have in our investment accounts, we don't touch. And yeah, we see them as separately. And that those cash sitting in the accounts really is meant for investing. Right now, as we get closer and eventually living off our portfolio, that's obviously a very different scenario, and we'll have to convert our way to thinking. And I'm sure that's what you're doing too, right, Nelson?
Yeah, for me, I look at cash as there's two buckets of cash, and one is inside the portfolio and one is outside the portfolio. And then what I do is this bucket outside of the portfolio, I make sure that it's, kind of a half filled all the time to full all the time, depending on, half full is kind of 6 months worth of spending and full is 12 months worth of spending. And so as I pull money out of the other bucket, I make sure that bucket is full. And then from that point, once there's, that bucket is full to the point where I'm comfortable where it's full enough for me, then I look at the other bucket and I say, okay, like, what am I going to do with this bucket? And so I might, like I said, I took some extra out to put aside for a car that I have to purchase. But like for the most part, that other bucket just gets reinvested and kind of, the opportunities that I see. And if I see that there are a lot of opportunities, then I will, there'll be basically nothing in the investment bucket. It's just all being reinvested as fast as I can, which was what was happening in 2023. Nowadays, I have to say that both buckets are pretty full, in terms of the amount of cash that I have, because I am having some trouble finding sort of the attractive investment opportunities I'd like to see. We're at kind of markets are very close to all-time highs as we're recording this. Who knows what's going to happen kind of geopolitically that may make the market freak out between when we record this and when you guys actually listen to it. But ultimately markets have gone up a lot, and that makes it a little bit more challenging for me to find stuff to buy. I'm still finding stuff and I'm kind of slowly putting this to work, but it's kind of more challenging than what it has been before. So at that point, I'm kind of, I have a choice to make. I can either keep that money in cash or I can put it in one of the various near cash options, or basically cash options that exist in the market. So I'm talking about things like the cash ETF, which is well, Bob, why don't you talk about, you're familiar with the cash ETFs and kind of what these things are. So can you kind of explain sort of what they are and kind of why would they be a good choice for parking cash for kind of the short term?
Yeah, just going back a little bit, I think some investors fully invest their cash, and some, like you, Nelson, keep some cash aside and look for opportunities to invest. And that's, it just depends on what kind of investors you are. If you're okay having a lot of cash sitting on the side and just deploy that strategically, and when the opportunity comes, that's perfectly fine. But I know some people, they get a little bit trigger itchy, and they just want to deploy cash. And if you're one of those, that's fine too. Just make sure you don't buy stuff that's overvalued, right? So there's no set rule that you have to do this way or that way, right? Like personal finance is very personal. So yeah, that's kind of my thoughts on whether to have a large amount of cash in your investment account or not. And this also depends on where you are in terms of your investing journey. If you're obviously early on, maybe you try to invest as much as you can and take advantage of your timeline. And if you're, like Nelson, in early retirement, then you maybe have a little bit more cash sitting on the side. So, and then if you're in the middle, maybe somewhere in between, right? In terms of the cash ETF, these are basically, you could see it as kind of like GICs, but with GICs, you're locked in for a certain time period, right? So there's 2-month GIC, 6-month GIC, 1 year, 2 year, 3 year, 5 year. I think there's been 10 years GIC, which is crazy, if you ask me. And with GICs, typically you can't touch that money, you can't take it out. You only get the interest once GIC matures. So you can imagine that's pretty restrictive, right? So if you lock in a year at, I don't know, $5,000, $10,000, you can't touch that money. If you touch it, you lose the entire interest typically. Now there are different GICs where they, you could take it out and they pay you a little bit less interest than what you would get. But for the most part, GICs are quite restrictive because that locked in time nature. With these ETFs, these are high yield savings account type ETFs. The beauty of these is these ETFs are traded on the market. So you could buy them, you could sell them pretty easily. And with the commission-free trading nowadays, you don't have to pay commissions anymore, right? So you could buy like a cash ETF, and typically they have pretty attractive yields. Now the yield of these ETFs will vary, depends on the interest rate. So you may get really, really high 1 month, and then they'll adjust something lower and it will fluctuate. But that's a good way to use your cash, and you let your cash earn some interest and making sure your cash is working hard for you. And the ETF trading nature means you're not locked in for a long time. You could sell it, you could get in and out really easily. So that would be one advantage of using these ETFs. Now, Nelson, what about the taxation side of things? I think people need to be aware when they use these ETFs.
Yeah, that's a really good point, Bob. The taxation of these ETFs is that you are paid interest, and that interest is taxable at your full rate. So it's like, whatever you get paid, it's the interest you get paid is going to be on top of kind of your salary and everything else. So that interest is going to be taxed at your highest marginal rate, kind of whatever your highest tax rate is, because it's tacked on top of the rest of your earnings. So you want to keep that in mind when you're using these. You're not getting paid dividends, you're not getting that dividend tax credit there. So that's going to sort of, that's going to factor into it. Now, for me personally, I really don't care about that, because ultimately I would rather have more money than less money. And if the government takes some of it, well, then they do. There's nothing I can really do to stop that. Of course, the easy way to kind of avoid that, if you are really hung up on taxes, and there are people out there who get really hung up on taxes, is that you just keep the cash in an RSP or a TFSA and you kind of do it that way. But the issue with that, of course, is that, like you're sitting on a bunch of cash, and that cash isn't, invested. The other danger of that kind of strategy is that you're really sort of timing the market by doing that, by saying, hey, I'm going to sit on a whole bunch of cash until this kind of the market falls or does what you want it to do. And there's just no guarantee that that's going to happen. And as I've said before, I think the average person's quite poor at trying to predict these kinds of things. So I wouldn't bother. I would be mostly invested at most any point. And, earlier I talked about I'm sitting on a bit of cash. The reality is it's like kind of 6% of my portfolio at this point. It's not very much in terms of the scheme of things. At least I don't think it is. Some people might differ, and that's, Bob said personal finance is personal, so that's fine. But that's the point, is that I don't think I'm making a huge bet here. I think it's just, I had a couple of stocks in Q4 that got acquired. Those are First National and Parkland, for those of you that pay attention to my portfolio. And I've just kind of been slowly putting the cash back to work, and then, the dividends keep flowing in and et cetera. So Bob, let me kind of pivot and talk about this. When they have cash and they want to put it aside for whether it's a house purchase or, whatever, just kind of they're saving up for something or whatever. I see a lot of people who will ask me, or they'll put it into something like, whatever stock out there that has a 6, 7, 8, 10% yield. They'll put it into US treasuries because US treasuries do yield higher than Canadian bonds as we kind of speak here today. And, there's this reach for yield almost with cash. What do you think of that strategy? And what would you say to someone who says, why would I put my money in the cash ETF, which pays, I pulled it up here while you were talking, it pays 2.33% as we are recording. Why would I put my money in that when I can get almost double that in a short-term US Treasury?
Yeah, so I'll talk about that. I guess the US Treasury is a little bit different than, say, a dividend stock that yields 6-7%. Let's talk about the dividend stock, or stocks that may yield, quite attractive, right? Anywhere north of 4%, that's called it, right? The danger there with the dividend stocks is the price could fluctuate, right? Even though you're getting, 4, 5, 6, 7%, the stock price could drop. It could also go up, but you don't know what's going to happen. Now, short-term stock market is quite volatile, and stock price tends to go up and down, right? And then with these higher yield ones, you're maybe taking on a little bit more risk. Like take a look at the telecom, right? The TELUS, the Bell, the Rogers, they all have really high yield, but look at what their stock price has been doing the last, 3-4 years, right? They've been going down, and they're kind of jumping up and down. Even if you take a look at like Enbridge, which has really good yield, sure, the stock price has been going up, but if you zoom in a short-term period, sometimes it could be pretty volatile. And the danger of, using the cash that you need short-term to invest in, call it dividend stock, is that you don't know when you need the money to buy, right? You don't know what the market is going to do. So imagine you need a new car or something, and say you have saved up, just arbitrarily put a number, $50,000 worth of cash, and you put it in a dividend stock that's yield 5%. Great, that's awesome. But imagine you put that money in, and let's go back a few years or a number of years. COVID happened, and the market freaked out, and all of a sudden the market tanked and the price tanked. But you need the money during that time. Well, you're essentially forced to sell at a terrible time when you need the money. So that's why you don't want to do that when it comes to investing in dividend stocks with your short-term cash need. So typically you don't want to invest in a stock market with cash you need for the next 3 to 5 years, right? So if you need cash within the next 3 years or even shorter, 2 years, depends on the amount, you probably want to keep that cash in a safer environment. Now, US Treasury bonds, Treasury bills, I think those are a little bit safer. I don't know too much about them. I think they're pegged to the interest rates and such. Maybe Nelson, you could talk a little bit more. But my thoughts would be you want to park in something safer, right? So you could either do, we talk about GIC, the restricted time nature, but you could spread the money out and do like a GIC ladder. What I mean is you could go in and say you invest, a quarter of your cash into a GIC that matures in 6 months, and then maybe a month later you lock in another 6-month GIC, and that way your money is kind of working for you and at different rates, and also they mature at different time periods. So that's another way to do GIC. Some people do money market funds similar to these to that cash ETF, but I like between money market and cash, like the high yield ETFs. Those are both of them seem to work in my opinion. Just depends on your preference. Nelson, your thoughts on the U.S. Treasury bill and money market versus these high savings ETFs?
Yeah, I'll talk about the U.S. Treasury bills first because I think that's it's an interesting strategy that doesn't work for a couple reasons. So generally, let me talk about the U.S. Treasury bills. They're just short-term debt instruments from the U.S. government. And because short-term interest rates are higher in the U.S. than what they are in Canada, you get a higher yield. I don't think there's any risk of the U.S. government defaulting on any of its short-term debt at this point. I'm not saying that, but what I am saying is that there are two big disadvantages for Canadian investors specifically. And I assume that most of the people listening to DY Wealth Canada are Canadians, so I'm just going to pretend that everybody has these disadvantages. Number one is currency risk. You cannot invest in U.S. treasuries in Canadian dollars. You have to do so using U.S. dollars. So what happens is that when that exchange rate moves, and that exchange rate is moving every single day, is that you create exchange rate risk going down the road when you need that money back into Canadian dollars again. If it's U.S. dollars now and it'll be US dollars later. Like, for instance, maybe you're buying a property in the United States. Maybe it's money that you've set aside to vacation somewhere in the world that takes US dollars. Then by all means, do that because you don't have that currency risk when you're converting back to Canadian dollars. But if it's a Canadian who wants to spend Canadian dollars and is just looking for a little bit of extra yield, that's a big risk because currencies can move very quickly sometimes. It can also move in your favor and, suddenly you convert back to Canadian dollars and you made your interest plus you made a, return on the conversion rate as well. And then, you're smiling, but it's just, my opinion is it's too much risk for cash. The other thing that is a little bit tricky when it comes to this is that, yes, there are ETFs that will let you kind of do this, but to buy U.S. treasuries from your brokerage, and a lot of brokerages will let you do this and some won't. I don't think it's an option in Wealthsimple, for instance. It requires a certain amount of sophistication in terms of doing that when, you can just use a much simpler product. And yeah, you might not make as much in interest, but, you don't have to actively buy bonds in a world where a lot of Canadians, a lot of investors kind of in general, just don't really understand the bond world. So I think those are two kind of major disadvantages. And maybe just like in general, I'll say that when you have cash, the last thing you want to do is reach for yield. We talked in an earlier episode about kind of the dangers of reaching for yield in terms of the dividend world. If you need that money in the next 6 months, in the next year, you don't want to take any risk with that money because the last thing you want is, hey, I have a nice house down payment. I'm going to take a little bit of risk with it. Oh no, now I don't have a very good house down payment. I have to save for, a year or 2 years or whatever longer in order to do that. Like, my wife would murder me if I did that. So that's, a very easy way for me to say no to that as well. So just keep that in mind that when you're doing cash management, it's cash and you don't want to take any risks with it at all, or at least very, very minimal risks. And that's why these high interest savings ETFs they're such attractive products because one, they offer liquidity, two, they offer pretty good yields, and three, the money is actually deposited with financial institutions, like good, solid financial institutions in Canada. The cash ETF, which is the one I keep bringing up, I think the majority of the money is in like National Bank and Bank of Nova Scotia. It's not lent out in risky businesses or anything. This is about as solid as it can get. Bob, any more thoughts on this before we kind of pivot to something else?
No, and I think that's something we're looking into. I alluded to that we're getting closer, and definitely the whole cash topic and how to withdraw money from our accounts is a topic that I'm looking into and planning. And obviously, there are different ways to withdraw cash from your accounts so you could live off from it, right? So you could withdraw one big sum at beginning of the year or end of the year, or you could spread it out, etc. Some people like to have enough, like if you're a dividend investor, enough dividends or cash in your account such that, say, it's now 2026, you're already saving for your expenses for next year. So you have that additional buffer. So it's all about margin safety and how comfortable you are with the way you treat your cash. Yeah, and I think the cash ETF, and there are other ETFs out there that are similar. I personally think we'll probably use the cash ETF more and more as we get closer to living off our portfolio. And like Nelson said, like reaching for yield when you're sitting on cash and short term, it's just not a good idea. There's just too much risk. And the way I see it is cash is just one of the levers you could adjust in your overall portfolio, right? So how you manage that obviously is going to depends on person to person.
Yeah, I think ultimately, when you have a higher cash position, you end up with more flexibility. And, you could argue that flexibility comes at a cost, and that cost could potentially be returns because, you just don't have all of your money invested at that point, which is fair. But that ultimately that flexibility is a big plus in my book. And also, you look at the risks of retirement and, kind of all the people that spent all that time analyzing it. And, the biggest risk is having to take money out in a down market when 2008 happens, when March 2020 happens, and all of a sudden your stocks have been whacked kind of 20, 30, 40%. And then you have to withdraw from that smaller balance. Like that's a big problem. And if these stocks don't recover and it takes a few years, all of a sudden you're taking money out at the worst possible time. And obviously you want to avoid doing that as much as possible. So how do you avoid doing that? And this is the question that I kind of asked myself when I analyzed my early retirement and that I kind of went in that direction. And the answer is, well, you have a healthy cash balance at all times. You withdraw primarily dividends and you don't try to sell too many shares, because if your retirement is based on selling shares, then you can often sell, or you're sometimes forced to sell at the wrong time, and that's a problem. But ultimately, it's just that kind of sleep well at night factor where, I can sit back and relax and just gotta know that, hey, if everything goes to hell tomorrow, I can kick that can down the road for a little while because I do have these healthy cash reserves. And ultimately too is I have the ability to borrow against my portfolio at relatively attractive rates, which would be like a last resort, but that option is there. And ultimately you're looking for flexibility when it comes to, early retirement, just to make sure that if things don't go as planned, you have options.
Yeah, for sure. I think it's just having options available to you. We could talk more about this topic, but having cash, some people have home equity line that they could tap into. There's credit cards and different sorts of things. And some people may have stuff they could sell if it really comes down to it. Ask like things at home lying around, right? There's the whole Facebook marketplace that you could get some cash from that as well. So there are different ways, and it just ultimately comes down to what you're comfortable with, and again, like how much cash do you put aside as rainy day fund or emergency fund versus living expenses. That again, that all comes down to personal preference, and it also depends on if you're earning, like if you have a side job and you're earning some income, maybe you don't need to put as much, right? So there's definitely no one rule to follow. There are many different rules. It's the same with investing, with personal finance, right? And that's been the big thing for me, is like people keep saying, oh, you have to do it this way, or it's wrong. And I always argue that that's not the right way to do things there, because it just depends on who you are and what you're comfortable with, right? So there's no one rule that everybody must follow, because if it's that simple, then the whole investing and getting wealthier would be super straightforward, but it's not, unfortunately.
Well, I'd actually argue that it is straightforward. It's just that we make it very complicated. And the other thing is that your point of, hey, everyone's journey is unique and whatever, like, you're absolutely right. And there's actually, what I love about finance is that there's like a million ways to kind of end up wealthy. And you can do anything from, boring dividend stocks, like that kind of stuff that a lot of Twitter thinks that you and I are nuts for doing, to, super high growth stocks, tech stocks, going in on margin, doing these things that I personally think are way too risky, but they sure did work out over the last kind of 15 years. Someone went balls to the wall, long, leverage long as possible in like 2010. Like, it ended up very, very well for them. So that's the beauty of finance ultimately, so that's what I like about it. But anyway, moving back to cash, because I think I've kind of got us a little bit off track here. I want to ask you, Bob, about the banks offering high interest savings account promos. So this is like, I know Tangerine was big for this for a number of years, where it was, hey, move your money over to us and we'll pay you kind of like 4% annually for 6 months. And then you go down to like 0.1% interest. Of course, they're doing this to attract deposits, which they can then lend out for mortgages and kind of do what banks do. So, Bob, do you try these things? Have you ever kind of chased these, high interest account promos, or is that something you don't bother with? Now, before you answer, I'll say that my wife 100% chases these, and she's fantastic at it. You just take the money and you basically, like, every 6 months you move it around. It takes very little work once the accounts are all open, and the money that, like, it just counts new money into this. So you can, in theory, kind of use a Tangerine bonus kind of over and over and over again. And they will offer you bonuses to kind of get you back. So anyway, that's kind of my spiel. Bob, have you ever done this, and, do you think it's worthwhile?
I personally have not chased these high savings deals, and even like some banks, they offer promotions when you open up an account with them. The reason I haven't really done that is just like you said, Nelson, it takes time to find deals and set up accounts and stuff, and we just haven't bothered. But I mean, I could see why that would be attractive, especially when you're in retirement and you're trying to get a little bit extra cash, or get your cash to earn a little bit extra. And in your retirement, you may have more time to look around for these deals, and that makes sense. So yeah, I would probably look more and more into these deals later on. One thing I noticed, like some banks, they may offer, like TD, Royal Bank, I mean, even other banks offer this, like, open up a checking account, you get some goodies or certain favorable rates. And if you look more into it, typically you have to you need to meet a few requirements, right? One would be you need to have like an ongoing deposit into that account. You have to spend a certain amount, like pay bills or regular bills and stuff like that. So there are a few extra steps you may have to take to get these promotional deals. But yeah, we haven't really chased these deals, but something worthwhile to look into, because if the market is paying, 1% yield on your cash, and then these promotion give you, 4%, 5% for as low as a short 6 months. Yeah, it's absolutely worth it to take advantage of these if you could find them and set up accounts. And nowadays, open up new accounts is getting easier and easier. You could do it online rather than having to visit these physical branches. So it makes sense to spend some time and look into these deals for sure.
Yeah, that's a very valid point about read the fine print and make sure that, there's nothing kind of screwy going on. You should be able to find where it's just, hey, like you transfer in the money, but you have to sort of back up here. What I've found, again, my wife does this more than what I do. She kind of takes it as a challenge of kind of, to screw over the banks, a little bit, like kind of beating the man. And so as a bank shareholder, I'm not sure how I kind of feel about this. But anyway, she takes it as a challenge and she's good at it. But, one of the things that I know she's told me before is that oftentimes you have to kind of go in, accept the rate, so tell them that, hey, I'm doing this, I want to do this, and then transfer the money in. Doing it that way get you is like, you're like, oh yeah, hey, like I'm going to do it, no problem. And then you don't actually qualify for the bonus because you haven't jumped through the hoops properly. So there are some kind of issues that you have to keep an eye on. It's still a perfectly feasible strategy, but you have to make sure, because ultimately these are for-profit businesses and they will kind of find a way to screw you over if they can.
Yeah, and one thing to keep in mind, not just the initial requirements, but some of them require you to keep the money for a certain time period after you receive the promotion. But I'm more thinking maybe not so much on these savings account, but like if you look at Wealthsimple's promotions, typically you need to keep that money in your account for at least a year. I think some now it's like 2 years. So you're thinking just like switch to one financial institution, get the promotion, and pull the money to another one. There's always these like back end requirements you need to be careful with. So always keep that in mind.
Yes, very much so too. And I'll just mention one last thing, which is that if you go in, you get the promotional rate. When that promotional rate is over, you have to be on top of it, or else you're getting like 0.03%. Like they make sure that once that promotional rate is over, you have to be on top of it and you have to kind of do the work to transfer that money to another bank, or else you're going to lose out on some interest. So it's like if you make 4% for 6 months and then you make effectively 0 for the next 6 months, I'm not sure how good of a deal that is. That's just a pretty good deal versus a, quite good deal.
Yeah, absolutely. And that's what you need to, if you're chasing these deals, you need to set up calendar reminders and such. It kind of reminds me of these, you see these online things where, you need to put in your credit card, it's free for 2 weeks. And then if you don't phone them or cancel your subscription, then you're on the hook, right? So same thing, that's how they get you. It's like most of the time people forget and then they get that money, or you end up paying more for these deals. So always keep in mind and put in a calendar reminder or some sort to make sure you get the most out of with your money.
Yeah, that's it. Ultimately, you're responsible for your own money and you have to make sure that you're doing the right thing. And when it comes to, just kind of cash management in general, I just think that the overarching message for me anyway of today's pod is just that, like, cash, don't treat your cash like an investment. Like take that money and then, once it's like gone from cash to an investment, then it's like, it's for the long term. It's not for the short term. Treat your short-term investments, your cash, very differently than your long-term investments. And for, a lot of people listening, I don't think that's very easy. For young Nelson, it was not very easy. Like I said earlier, it was just go, go, go. I was very serious about getting ahead. And that's fine. Just keep that in mind, kind of that, they're two very different asset classes. And if you treat them the same, there's potential for it to end in tears.
Absolutely. And again, you may change your cash management strategy and find one that fits, and the scenario changes too. So that's another factor to consider.
Yeah, absolutely. And as you get older, I think most people kind of get, more risk adverse as they get older. But at the same time, like I realize my experience is not unique to everybody. And, if I was in my 40s and I didn't really have anything saved for retirement and I knew that I was kind of falling behind, then my attitude may be different, at that point. Ultimately, I think it's like circumstances that affect kind of that risk outlook a lot more than someone's age ultimately.
Absolutely. I think we're coming up to the end of this podcast. Anything else to add, Nelson? Any last minute topics or ideas that related to cash management?
I will ask you real quick, Bob, the idea of having actual physical cash at home. Do you have any?
That's a funny question. A very good question. We honestly nowadays very little. In fact, we need to. My son wanted to get some Lego from this guy from Facebook Marketplace tomorrow, so we're getting. We need to get some cash from the bank because we don't really have that much cash sitting around. It's only like $100, but that tells you how much cash we keep at home. No, generally speaking, don't really keep much cash aside. At home, it's like when we need it, we go to the bank and get it out. What about you, Nelson? Do you keep a lot of cash at home or same as us?
I have like a change jar that I had when I had cash. So, 10 years ago, I definitely had cash. Like I paid with things by cash and, like I had a credit card and I used it too. But, it's just gone from having hundreds of dollars at any point in my wallet to I can't remember the last time I had actual cash in my wallet. And Bob, it's the same as you, where it's like if I need cash, I have to go to the bank, find an ATM, and it's just such a giant pain in the what that I almost it's got to the point where it's like if there's a situation where I need cash, I just avoid it because it's just annoying.
Yeah, I think for the most part nowadays, credit card is the king, or debit card, right? Like, there's really no reason to carry cash around. I mean, I probably have like $5 in my wallet at all times, just so I, in case like the machine breaks or something, I have something. Although $5 doesn't go a long way nowadays. So yeah, I mean, we could talk about that in another episode in terms of credit card hacking and things like that. It's not really the main topic of this podcast, but it's certainly something as you look into, if you want to build wealth and want to get into the travel hacking side of things, that's another interesting topic to discuss, and that's a very wide topic as well. But yeah, I think nowadays, like, what's the reason of keeping a lot of cash at home? Not really, right? Because I think last time I used cash, I guess a few days ago there's a raffle thing at work, and I just happened to have cash in my wallet. That's how I was able to enter this raffle contest. But otherwise, if somebody came around, there's been times where somebody came around and said, "Oh, there's a 50-50. Do you want to buy it?" And I open up my wallet and I don't have enough cash, so I can't participate. So that certainly has happened before.
Yeah, exactly. Okay, so I think we'll wrap it up. As always, thanks everyone for listening, and let us know in the comments if Bob mentioned maybe doing an episode in the future about credit card hacking and kind of things like that. Let us know in the comments if that is something you want us to talk about, or if you want us to shut up about that forever. Hey, once again, I'm Nelson. You're listening to Bob. We're the DIY Wealth Canada podcast. Thanks for listening. We appreciate it. We'll see you next week.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.